Hey, how's it going? This is 0 Days to Expiration podcast, episode number 92. And the reason for tonight's episode is to take a look at the market going forward. Now, right now, if you've got a chart in front of you, you can obviously see that the futures are down. They're not down huge, but they're down significantly, about 1.4%. On a Sunday night, that is remarkable, quite frankly. And of course, when the market opens up tomorrow morning, if prices stay where they are, the SPX is going to gap down significantly. That will be the second gap down, huge gap down, that the SPX will have consecutively from Friday and also today. And quite frankly, I've never even seen the size of the gap down on Friday, going back in history, maybe, years. And of course, all of this is because of the transitory peak inflation. I say that in jest because, of course, we heard the idea that inflation was only transitory. Actually, going way back, they were attempting to keep inflation down below 2%. It started to rise. They ignored it. They talked it down. They said that it was all transitory, and it just kept on rising and rising. They kept on pointing to core inflation as if ignoring food and energy and just concentrating on those things that they call core would give us some insight as to where inflation would go. Of course, they were wrong there as well. And to this day, they are looking at core inflation and also looking at commodities and saying that, in fact, there are some people talking about us going into a deflationary cycle, while inflation is at its highest point in more than 40 years. Of course, if you were to calculate it the way they did 40 years ago, we would be blowing those inflation numbers away. Now, 40 years ago, and here's the other problem. When you start talking about comparing older dates to this date, you get a lot of folk saying that they're not comparable. There are too many differences in our economy. And I would say, yeah, that is correct. But they will say it to try to feign that somehow we're in a better situation, when in fact we're not. We're in a much worse situation. And we're taking a more dovish approach, I don't know how else to put it, to solving this problem than they did back then when their inflation numbers weren't as bad as they are now. Back then, the then head of the Fed, Volcker, he put the pedal to the metal and raised interest rates dramatically. And yes, it did send us into a recession. We're going there one way or another. There's just no doubt about it. But we could do it the easy way, or we could do it the disastrous way. Back then, they raised interest rates dramatically, much more than what we're proposing these days. I think there was one hike as much as 5 or 7%. It was just crazy. And I remember back then, back in the 80s, you could buy a 30-year bond with 15, 16, 17% interest. People were getting mortgages with 15% interest, car loans with 20% interest. I mean, that is just, we're all used to over the past decade or decade and a half of everything sub 3%. And so this is a whole new world for people. If in fact that they capitulate and actually raise interest rates the way they need to, it's either that. They talk about this kind of soft landing that we're going to, things are bad and market's coming down. We're probably going to go into bear territory, but it's going to be a soft landing and we're going to escape. Goldman Sachs, as a matter of fact, just came out the other day saying that we were going to escape a recession. I think everybody knows that we're already in a recession. I don't see how you avoid a recession. There is nothing in the economic numbers that would suggest anything other than a recession. And of course, a recession is 2 consecutive negative GDP. Even if you go by the numbers that they're claiming right now, where they say that, yes, there will be 0.9% growth in the second quarter. If you took the negative 1.5% growth in the first quarter and you add that to 0.9% growth, you're still talking about a negative over the first 2 quarters of 0.6%. So no matter how you look at it, it's a recession. But I'm willing to bet that when those GDP numbers finally come to bear, that we're going to be looking at something on the order of 2 or 3% negative growth in the second quarter. But that's down the road. We don't have to worry about that now. And when that happens, the situation that we'll be in at that time, it'll seem that's nothing, or we'll be happy if we get 2 or 3% negative inflation or negative growth. What's going to happen this week is what's important. Now, people see the futures down today, and a lot of people are talking about a Black Monday, and I don't think that's going to happen. I don't think that's going to happen because Wall Street is really waiting for the Fed to make their move. They need to know what the Fed's going to do. They don't want to commit to bringing this market down without understanding what the Fed has in mind in the next couple of days. Now, it's going to be the Fed show for almost the entire week. We have Fed governors speaking tomorrow and Tuesday and Wednesday, and Powell speaking on Thursday. And of course, they're going to be releasing their minutes, I believe, on Wednesday. Let's see. We'll go to the schedule, and we'll do an accounting of what's going to happen this coming week. So on Monday being June 13th, there's really not a lot going on. There's virtually nothing except that at 2 p.m. we have Fed member Brainerd speaking. And he's going to talk about Community Reinvestment Act. I doubt very much that's what he's going to be talking about. But if he takes any kind of questions from the press, it's going to be, how do I say this? The Fed is trying to be unified in their narrative, and he can't get ahead of the FOMC coming out later. So on Tuesday, we have some important numbers coming out. We have the PPI at 8:30 in the morning. And the PPI is a leading indicator of consumer inflation. Right on target. And this is a big number. And it's going to be talking about core inflation. Now, the PPI and then the core inflation, I think, I really think that it's an opportunity for the Fed and the mainstream media to spin this and perhaps even manipulate the numbers, because one thing's for certain. Numbers can be manipulated, and then they can be revised later. Everything's about timing. We're going into a Monday where markets are down. We are within just a few points of hitting the recent lows that would send us into bear market territory. Let's see, that was on May 20th. On May 20th, we dipped into bear market territory very briefly, which is at about 38.26 on the futures. Very briefly, and then shot right up and then went into a bear market rally like you've never seen before. It was just straight up. And then, of course, we've been consolidating for about 9 or 10 days. And then finally, everything broke, and that's where we are now. Now we are within let's see, the futures got down as low as 38.32. So within 12 points of that previous low. Now that low, how old is that low? That low goes all the way back to, let's see, way back here. Looks like March 3rd of 2021. That was the last time we saw anything that low. Now that represents, that point, a 20% correction. And anything below that is more than 20%. And anything more than 20% is considered a bear market. That changes the whole narrative. Of course, if we go into a bear market, if we close on a closing basis, so we go into a bear market. Now that's a very important point, because on May 20th, when we did hit that, we did not close into a bear market. We just dipped our toe and then popped right back out. If we close into a bear market, then the narrative flips. The news media is going to run with that. The talking heads are going to run with that. Everyone's going to have an opinion, and it's going to be a shite show. That's the way it's going to be. Now, the question is, will we dip there and close below that point or not? Is the market willing to go there prior to the Fed coming out on Wednesday? Let's see, we'll bring up Wednesday now. Of course, we have the PPI on Tuesday. And we don't have any Fed governors or anybody coming out to talk. And then also, we have a tentative report, the IBD Economic Optimism Report. That sounds almost humorous. That's like a comedy sketch. And then on Wednesday is a big day, because at 2 o'clock, the FOMC economic projections, FOMC statement, and then the funds rate will be announced. Now, currently, if you were to look at the current projection by the CME, and just last week, it was almost universal, 100%, that rates were going to be raised 50 basis points. And then over the past few days, since we broke out of that consolidation and started moving down rapidly, that's changed. Now it's only a 70% chance that we'll be raising 50 basis points, because 30% now is going towards as much as 75 basis points. Now, we know that Jerome Powell said before that he would not go as high as 75 basis points. He was planning on just keeping it at 50, 50, 50 for a while. So that's interesting. So that is an inflection point. And not only which route they choose to go will be important, but also the narrative that they choose to accompany whatever their decision is. The market has to take all of this in. They have to get all their linguistic experts out and look at all the wording inside of the minutes, and they're also going to pay strict attention. And I don't expect that the Q&A session that's bound to happen there won't be anything that will be free-flowing. No free-flowing information. They'll stick to the script. So then now we have to move a little bit further into the week, right? So I have to switch over to here. We go to Thursday. Oh, by the way, also, there are other very important reports that are happening on Wednesday. On Wednesday, we have core retail sales and Empire State Manufacturing. Wednesday is an unbelievably impactful, potentially impactful day. You also have crude oil inventories. Of course, that talks directly to the energy crisis that we're having here, with gasoline in some states breaching $7, with the national average over $5 now. That's going to come into play as well. And it's interesting that normally in these economic report manifests, they have crude oil inventory reports as one of the more impactful reports. But right now, energy seems to be taking such a backseat to the other things that they don't mark it up that way anymore. Now, we also have, like I said, on Wednesday, we have the FOMC across the board, and then they have a press conference at 2:30. That's going to be huge. I think the market is going to wait for the results of that press conference. I don't think that they will be able to temper at least an initial reaction with the market after the minutes have been released. So there will be something impactful that will happen as those minutes are released, and we may get a huge drop, or we may get another bear market rally. Who knows? I think that any bear market rally that we have is going to be an opportunity. It's going to be short-lived. It will be an opportunity for you to exit your equity positions, or at least hedge them, or do whatever it takes, because from there, and it's going to be fleeting, if the wrong thing is said, this market is going to drop hard, very hard. But I don't think that's going to happen until Wednesday. Now, what's happening on Thursday? I haven't even looked as far as Thursday. I don't know that it really matters, to tell you the truth. Oh, on Thursday, we have the Philly Fed Manufacturing Index, followed by the unemployment claims. And of course, over the past couple of weeks, few weeks, those unemployment claims have been rising steadily. The JOLT jobs report and the ADP reports have been decidedly negative. The unemployment report that we had, the job situation report that we had just recently, was really bad. So that's going to be another thing. And here's another one: housing starts, and of course, natural gas storage will also be very impactful. Thursday is also another very potentially impactful day. Now, what about Friday? Is anything happening on Friday? To cap it all off, at 8:45 in the morning, before the market opens, Fed Chair Powell will be speaking. And what will he be talking about? He's due to deliver welcoming remarks at the inaugural conference on the international roles of the U.S. dollar in Washington, D.C. We know what the role of the U.S. dollar is in Washington, D.C., and that is to create more dollars so that you can finance all the spending. And again, I wasn't going to delve into why we're in this mess. We all know why. And it just seems ironic. I don't believe that whatever he talks about, it will not be about that. It's going to be CYA time, big time, or maybe more appropriately or accurately. I think there's going to be some sort of opportunity for the political parties to start doing some sort of blame narrative. Now, the other possibility over the coming days is that the White House decides and the Congress decides to ramp up their January 6th hearings, which aren't really hearings, because if they were hearings, you would have opposing views, and there are no opposing views. It's basically a propaganda piece. And I'm sure everyone has a different opinion of that, but you have to call it what it is. So that's another thing. I think that they may try to divert attention from the malaise that's coming. Just a guess. But I think that it would be so obvious that it may hurt them more than help. But they've got a lot of things in the air. And so that's what we've got going for us this week. Now, currently, the volatility index, it was on the rise last week. And it popped up pretty good, but it also pulled back on Friday. A late day pullback. But right now, I see the VIX moving outside of the Goldilocks zone. When I talk about the Goldilocks zone, that's a zone on the VIX between 17 and 34, and that is like the sweet spot for traders. I think that it's going to move above there and move out with reckless abandon. It's going to shoot high. And that also is going to present tremendous opportunity for option sellers like ourselves here at 0DTE. So at 0DTE, we're going to relish this. And there is going to be plenty of trades. Of course, we have our midday or mid-morning trade, and we have our final hour trade. They're going to be exciting. We won't be taking a lot of chances. There will be no need to. Those chances will come to us, and they should present some pretty good opportunities for us to profit because we will have so little exposure into the market. These markets don't hurt us. You can almost say that this strategy, the zero-DTE strategy, it's bear market proof and it's recession proof because it doesn't care. We don't care. We get more volatility. It just presents more opportunity for things to work in our favor, things like probability of touch and elevated premium. All of those things will be wonderful. And they will just be just like every other day, only it'll probably be just a little bit easier to collect profit. That's how I see from our point of view. And of course, if that's the only strategy you're doing, then you're going to be fine. If you have other equities in the market, then you've got some serious thinking to do here. The dollar is likely to blast off. What you want to do is you want to watch gold and see whether or not it holds its position. Because as the dollar is rising, gold has been doing a pretty good job of staying steady. And that relative change between the dollar and gold is really saying that gold has actually been doing its job from an inflationary point of view. Because if the dollar was down where it was before and hadn't moved, if it wasn't going on this meteoric rise due to the Fed action, gold would probably be at $2,500 an ounce. So gold is doing what it's supposed to do, and it will eventually realize the prices that it needs to realize. The dollar's getting weaker, even though it's getting more expensive. And that's because it's more expensive relative to all the other currencies that are around the world. So that's my prognostication. That's what I think is going to happen this week. I don't think that we're going to go into bear market territory immediately. I believe the market is going to reserve that for Wednesday. They're going to try to. And there's going to be a lot of people trying to push that darn thing down. But it is too risky, I think, for Wall Street and the big players to jump ahead of the Fed before they really understand what the cost of money is going to be. So that's what I think is going to happen. I think ultimately we go down. There's going to be huge spikes in volatility in the middle of the week. And from there, I guess it really depends on just how courageous or spineless the Fed actually is. They've proven already that they are spineless. I don't want to go so far as to say that, man, they are so dumb. They just missed everything. Because they're smart people. They see what average consumers saw all along. We saw inflation wasn't transitory. We saw that we're not at peak inflation. It's so obvious. So they're not stupid. So there's really only two possibilities. Either they're stupid or they're lying. And why are they lying? They're lying for political purposes. You would say, well, the Fed's supposed to be this independent agency, right? And they're supposed to work outside of the political spectrum, but that's not true at all. They are 100% political. 100%. And again, from our point of view at zero-DTE, it really doesn't make a difference. And that's because we only look at small instances and slices of time within the market. And when we have high volatility, that's fine. We might not be able to get one of our famous pin trades and make 1,500% or 2,000%. We could. I don't know. But we certainly will profit from this, from the movement. There's no doubt about it. So from our point of view, we'll weather this fine. It'll be fun to watch. We'll be in that kind of unique position where we're not really worried about the market and our plays. I mean, we're worried about the country, for sure. All of this just spells havoc for so many people. But from a trading point of view, it's cool. That's what I wanted to say. I think that, again, just to recap, I think that we're not going down immediately to bear market territory, but when we do, it's going to be a sea change in the mainstream media and the attitude of people, and possibly also the hawkishness, or, the hawkishness of the Fed. And then Wednesday, when we have the minutes released and then the press conference afterwards, there's going to be tremendous volatility. And then whatever happens that day will shape Chairman Powell's speech later on. And of course, we have the CPI numbers and the energy numbers and PPI numbers and everything. It's just going to be incredibly entertaining. All right. So there you go. It's getting late. Got to get up early and get at all this. Thank you very much for joining me this evening. And we'll see you next video or next podcast. That'll be coming up this week. Peace to you all. Take care.